Welcome to the 2013 Employee Benefits Series. My name is Gretchen Osborne, and I'm an Employee Benefits Manager at Sikich. I'm pleased to present 20 Minutes to Understanding Your Non-Discrimination Test Reports. Non-discrimination testing is complex, and it requires careful application of some detailed rules. These 20-minute on-demand webinars will assist you with the completion of the information that we need to perform testing for your plan and help you understand and evaluate your plan's test results. We're going to start out by giving you a quick overview of testing. We'll talk about highly compensated employees and key employees. Who are they? What are the requirements? We're also going to address some of the most frequently asked questions, such as who should be included in my census? Do I need to report everyone that I employ? What compensation should be included in the census? From there, we'll talk about the minimum coverage test, the ADP and ACP tests, the annual additions limit test, and the top-heavy test. And so if you're ready, let's begin. As you know, qualified plans get a tax deduction, and the people who participate in qualified plans are entitled to tax benefits. So if you have a qualified plan, you must be able to demonstrate that your plan is compliant with certain rules and regulations and does not exceed certain limitations or overly favor the highly compensated employees. The limitation tests include the participant annual 402G limitation, the participant annual additions limitation, and the employer deduction limitation. The non-discrimination tests include the minimum coverage test, the ADP and ACP tests, the compensation ratio test, the top-heavy test, and cross-testing and the general test for contributions. So let's talk about the retirement plan questionnaire and the census. The questionnaire and the census raise several questions, such as the ones we have here. Plan sponsors need to be prepared for these questions. The questionnaire and census information should be gathered as soon as possible after the plan year ends so that testing can be performed accurately and any corrective distributions can be made in a timely manner. It's also important for employers to be aware that related companies may impact testing and to disclose any and all ownership interests or service affiliations. On the retirement plan questionnaire, we ask plan sponsors to list the owners and their ownership percentage. What does ownership mean if a plan sponsor is a corporation? What does it mean for a partnership or an LLC? In a corporation, we're going to look at stock, but there can be different kinds of stock in a corporation. Essentially, anybody who owns more than 5% of the stock or has more than 5% of the voting power of the stock is going to be considered an HCE. With partnerships, we're looking at either the capital interest in the partnership or the profit interest in the partnership. So if an individual has a 3% profit interest, but a 10% capital interest, they're going to be considered an HCE. In an LLC or an LLP, we're going to look at the membership percentage. If an individual's membership is more than 5%, then they're going to be considered an HCE. When we test, we also think about something called family attribution or attribution from an organization. An individual can be considered to own part of a company that is really owned by someone else, and attribution can be between spouses, from parent to child, from child to parent, from grandchild to grandparent. You can't have attribution from grandparent to grandchild, and you can't have attribution between siblings. Let me give you an example of how this works. A husband and wife each work for a firm, and the husband is 100% owner of the firm. So by family attribution, the wife would also be deemed to own 100% of the business and would therefore be a highly compensated employee because she would also be more than a 5% owner. Attribution can be the result of an organization, partnerships, estates, trusts, corporations. Now let's talk about highly compensated employees, or as we call them, HCEs. If a plan discriminates in favor of highly compensated employees, it can't be considered qualified. There's two tests that we use for HCEs, the 5% owner test and the compensation test. Let's first look at the 5% owner test. If an employee owns more than 5% of the employer or a related employer, they're going to be considered an HCE regardless of his or her compensation. The more than 5% owner test is looking at any time during the current plan year, or as we say, the determination year, or the immediately preceding plan year, or the look back year. So we have to look at both years. If, for example, a 25% owner sold their ownership this year, they are still a more than 5% owner because we have to consider the immediately preceding plan year. Likewise, an employee who became a 10% owner this year but didn't own anything last year, they would still be considered a highly compensated employee. Now let's talk about the compensation test. An employee is an HCE under the compensation test if the employee's compensation for the immediately preceding plan year is more than a prescribed dollar amount. And that would be subject to what we call a top paid group election, and we'll talk about that in a little bit. But just keep that in mind. If their compensation is more than a prescribed dollar amount, then they may be considered a highly compensated employee. Now, for the compensation test, we're looking at compensation that is paid by the employer during the immediately preceding plan year and exceeds that dollar limit. And that dollar limit is specified each year depending upon cost of living increases. So we have to look at that dollar limit each year to determine whether or not an employee is above the compensation threshold. Gross compensation, and when we say gross compensation, we mean it's going to include pre-tax deferrals to 401k and Section 125 plans. So if an employee made salary deferrals to a 401k plan and a cafeteria plan, we have to include that in the definition of comp. Anyway, it's gross compensation that we're looking at, and it's full year comp even if the employee enters the plan mid-year. You can see the dollar limits here for 2012 and 2013. It's $115,000. So if an employee earns compensation above these limits, regardless of ownership, they could be an HCE. Now we're probably at a good place where we could talk about the top paid group election, which I mentioned just a moment ago. Under the top paid group election, an employee satisfies the compensation test only if the employee was in the top 20% of employees for the preceding plan year when ranked by compensation, and the employee's compensation for the prior year was in excess of the required dollar amount. So when would an organization use this type of an election? Well, generally you'll see it with an organization that has many highly paid employees, such as a law firm or physicians. So just keep in mind that a plan sponsor can limit the number of HCEs by compensation to the top 20% paid group. Now we're ready to talk about key employees and the tests for determining who a key employee is. On the census, we ask you to confirm all the key employees, and an employee must satisfy one of three tests to be considered a key employee. There's the 5% owner test, there's the 1% owner test, or they must satisfy the officer test. And we're looking at the 12-month period that's ending on the determination date, which is usually the last day of the preceding plan year. So let's first talk about the 5% owner test for key employees. The 5% owner test says that any employee who owns more than 5% of the employer or a related employer at any time during the plan year would be considered a key employee. So an employee must own more than 5% of the employer or more than 5% of a related employer to satisfy the 5% owner test. There is no minimum compensation, for a person to be considered a key employee under this test. So for example, if a 50% shareholder receives compensation of more than $50,000 for a plan year, he or she is going to be a key employee because he or she owns more than 5% of the employer. So keep in mind that the 5% owner test requires a careful review of the ownership attribution rules for families that we talked about earlier. So that's the 5% owner test. Then we have the 1% owner test. An employee does satisfy the 1% owner test if the owner both owns more than 1% of the employer and has annual compensation in excess of $150,000. Now let's take a look at the officer test. An employee will satisfy the officer test if the employee is both an officer and he satisfies the top-heavy plan compensation requirement. The compensation requirement is that the officer must earn more than a certain threshold during the testing period, and this amount is subject to cost of living increases in $5,000 increments. For 2013, an officer who has annual compensation greater than $165,000 may be considered a key employee. Now I say maybe because there is a limit on how many officers may be considered key employees in a given year. The maximum is the greater of 10% of the number of employees, or 3. However, no more than 50 officers are treated as key employees, even if the 10% is greater than 50. So let's talk about what an officer is. An individual's status as an officer is a facts and circumstances determination, and they take into account the source of the employee's authority, the term for which the employee is elected or appointed, and the nature of the extent of his or her duties. So the regs define an officer as someone who is an administrative executive in regular and continued service with the employer. Now we're ready to talk about the census and who should be included in the census and what compensation should be included in the census. So you should include all eligible employees who were eligible to participate in the plan at any time during the plan year being tested. And you'll want to include those who were terminated during the year and elected not to participate. And you should also include those who met the eligibility requirements and reached an entry date, but just chose not to defer. And what compensation are we looking at when we are submitting our censuses? What we'd like to have on the census is 415 compensation. It should be included for all employees who were employed at any time during the plan year being tested. 415 compensation is used to determine highly compensated employees, key employees. We use it to calculate plan limits and the top heavy minimum contribution. So if you have a plan, you're going to include 415 compensation, but if you have a plan that excludes any form of compensation, then the amount of compensation that you're excluding by plan definition should be reported in a separate column on the census, including if there's severance pay. So you may have just one column that you're using if all you have is 415 compensation, but if you are excluding any forms of compensation, then we do ask that you report that in a separate column on the census. Okay, so let's talk a little bit about what 415 compensation is. 415 compensation generally includes all compensation earned while employed. That means all federal compensation plus any before tax contributions to a tax qualified plan. 415 compensation does not include other amounts not currently taxable to the employee, such as stock options, non-qualified deferred compensation, or moving expenses deductible by the employee. So if the plan document defines more than one type of compensation, we have to track each one. So incomplete or inaccurate compensation can really cause some problems, especially if we're allocating contributions that's based on compensation, or if we're calculating limits, or demonstrating compliance with the non-discrimination requirements. So keep that in mind. The more complex your plan compensation definitions, the more difficult it will be to administer. Okay, while we're talking about compensation, it's important to note that there's a dollar limit on plan compensation, and the code provides that a plan can't base contributions on compensation in excess of an annual limit. That's code section 401A17. So the limit is taken into account for non-discrimination testing as well. And if a participant has compensation in excess of the dollar limit on compensation, then we're going to ignore that excess amount. The limit is adjusted each year for cost of living increases. And for 2013, the limit is $255,000. So it's important to keep that in mind. There is a dollar limit on plan compensation. And that concludes our presentation for today. I hope this was helpful to you. Please be sure to join us for our next webinar, 20 Minutes to Understanding Your Minimum Coverage Test.